The 30-year U.S. Treasury just crossed 5.19%. Japan's 30-year bond just hit an all-time record, a level that has never existed in the history of that instrument. The UK's 30-year gilt is at its highest since 1998. Germany's Bund is at levels not seen since 2011. This is not a blip. This is not a correction. What is happening right now across every major bond market on Earth is a structural regime change, and most investors have absolutely no idea what it means for their money. I'm going to give you the real picture in the next few minutes. Stay with me. Let's start with the basics so we're all on the same page. When bond yields go up, bond prices go down. And when yields spike like this, across every major country simultaneously, it means investors worldwide are demanding more compensation to lend governments their money. Why? Because they don't trust what they're being paid back in. Three things are happening at the same time, and the collision of all three is what makes this moment genuinely historic. First, the Iran war energy shock. The Strait of Hormuz closure sent oil from $72 to over $118 a barrel. US CPI is now at 3.8%. PPI is at 6% annually. Import prices up 4.2% year over year. The bond market isn't reacting to today's inflation. It's pricing in the inflation pipeline that hasn't even hit official statistics yet. And JP Morgan is warning that global oil inventories could hit critical floor levels by September. If that happens, we're in 1979 level energy shock territory. Second, fiscal dominance. The U.S. national debt is now over $38.6 trillion. The One Big Beautiful Bill passed last year locked in massive spending permanently. The bond market has looked at those numbers and made a decision. We want a higher premium to hold your long-term debt because we no longer fully trust you'll pay us back in real terms without inflating it away. That's what term premium repricing actually means. It's the market saying, we see the debt, we see the deficit, and we're charging you for the risk. Third, and this is the one almost no one is talking about, Japan. For 30 years, Japan was the silent engine of global capital flows. Here's how it worked. Japanese rates were essentially zero, sometimes negative. So Japanese pension funds, life insurers, banks, they couldn't get any yield at home. They took that cheap Japanese money and bought US treasuries, European bonds, global corporate debt. Japan became the single largest foreign holder of US treasuries, $1.2 trillion as of late 2025. Their total net foreign asset position, $5 trillion. They were the buyer of last resort, the quiet stabilizer, the reason global yields stayed lower for longer than they should have. That era is over. The Bank of Japan has been raising rates for the first time in decades. Japan's 10-year yield is now at 2.78%, a 30-year high. The 20-year just hit 3.59%, the highest since 1996. The 30-year, all-time record. And there are 3 BOJ board members pushing for rates to go even higher at the next meeting, with June rate hike odds priced at 77%. Here's what that means. For the first time in a generation, Japanese investors can get a real return at home. They no longer need to park their money in US treasuries to find yield. So they're bringing it back. Slowly, structurally, not panic selling, but redirecting new flows home, letting foreign holdings mature without reinvesting. The US has no replacement buyer for that capital at that scale. No one else on Earth has $1 trillion sitting there, ready to absorb our debt issuance. And yet, we need to sell more treasuries than ever before in history. That is a supply-demand mismatch with no easy fix. And then there's the Warsh factor. Kevin Warsh, the new Fed chair, is a sound money hawk. His defining policy departure from the Powell era is something called active quantitative tightening. Not just letting bonds roll off the balance sheet passively, but actively selling treasuries and mortgage-backed securities into the open market. Translation: for 20 years, the Fed was an artificial buyer of long-term bonds, which kept yields suppressed. That's over. Warsh is removing the price floor. He's telling the market, you figure out what long-term debt is worth. We're stepping back. The result is the death of what traders call the Fed put, the implicit guarantee that the Fed would intervene to cap yields in a crisis. Without that safety net, the term premium, the extra yield investors demand for holding long-term debt, is repricing structurally upward. Not for a quarter, not for a year, structurally, permanently, until fiscal discipline is restored. So what does all of this mean for the assets you actually hold? Equities. Higher long-term yields are a gravitational force pulling valuations down. Every percent that the 10-year rises compresses the theoretical fair value of a 25x PE market by 15 to 20%. Stagflation odds on prediction markets are now priced at 40% for year-end. In stagflation, stocks face earnings compression and multiple compression simultaneously. The Fed can't rescue you because it's fighting inflation. There is no easy out. Bonds. The 40-year bull market in bonds is over. The structural drivers that sustained it, globalization suppressing wages, China exporting deflation, demographics, have all reversed. The term premium was near zero for a decade. Its normalization alone implies 10-year yields well above 5% and 30-year yields approaching 5.5 to 6%. Sitting in long-duration bonds right now is like catching a falling knife. Real assets, gold, silver, hard commodities. This is precisely the environment they were designed for. Real yields are negative or low when inflation runs above nominal rates. Fiscal debasement is accelerating globally. The traditional 60-40 portfolio hedge is broken. Stocks and bonds are now moving in the same direction, down. Gold fills that structural gap. Central banks worldwide are buying at record pace. That's not a coincidence. Here's the part that keeps macro analysts up at night. There are 4 self-reinforcing feedback loops now in motion. 1. Japan repatriates capital, Treasury yields rise, U.S. deficit gets more expensive, more bond supply hits the market, yields rise further. Loop. 2. Higher yields mean higher interest payments on $38.6 trillion of debt. The deficit gets bigger, more issuance, higher yields. Every 100 basis points of higher average borrowing cost adds approximately $380 billion to annual U.S. interest expense. Loop. 3. 30-year mortgage rates are already above 6%. Housing is frozen. Construction slows. Consumer confidence drops. Growth weakens. Stagflation deepens. Loop. 4. Trillions in corporate debt issued at 2021 and 2022 zero-rate levels is now refinancing at 2026 rates. That's a direct earnings headwind and a default catalyst for the most leveraged borrowers, particularly private equity portfolio companies. The private credit crisis I covered in a previous video is getting worse, not better. Loop. The Iran war lit the match. Japan's normalization poured the fuel. The Warsh Fed removed the fire extinguisher, and 3 decades of fiscal rot in every major developed economy provided the kindling. This is a regime change. The era of cheap money as a structural assumption, the assumption that underpinned every asset class valuation from 2009 to today, is over. The playbook that worked for the last 15 years will not work for the next 5. If you want to understand what does work, hard assets over financial assets, shorter duration over longer, real over nominal, hit subscribe, because we are going to be covering every development in this crisis in real time, and this story is just getting started. I'll see you in the next one.